Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Phil Pecsok, the founder of Anacapa Advisors out there in Los Angeles. It's a hedge fund. We are doing a bit of a back to basics program here today. We normally talk about things that are in markets. We're going to do that later, but we're going to do something a little different today, which is basically have you, Phil, make the case for contrarian investing. This is not something I believe that we've ever actually done. We've always kind of operated under the premise that people know what contrarian investing is, they understand it, and they see its virtues. Maybe not everybody does, but it's good to do this refresher, but also more importantly, for this to come from somebody who's been in the field trading and investing for 30 years, as you have, rather than somebody like me or somebody else. With that, why don't we kick it off? What, in your understanding, what is contrarian investing and how do you use it? Let's start there.
Well, Nat, thanks for having me on your program. Excited to be here. The contrarian investing, I think, is, and this is great that you're doing this on your podcast, because understanding fundamentals of whatever you do, whether it's fundamental analysis or just fundamentals of coaching a sport or understanding math or whatever, is always important. So fundamentals of contrarian investing are very important to understand. And that is, one of the lessons I learned early in life is, and it doesn't always make sense, but I learned it in gold because gold was popular. And what happens is when everybody is in an investment, okay, they no longer are potential buyers. And you use gold. If everybody says you have to own gold, and everybody buys gold, technically now you're a potential seller, okay? So the holders of everything, whenever you say, hey, there's a stock, you have to own NVIDIA, you have to own something, and everybody owns it, a lot of those people, if they run out of cash, those are now potential sellers. That makes sense. And the opposite is true. A simple bear market is a great example. In 08, 09, when the market was dropping, everybody started getting scared. And when they freak you out to the point that you just don't want to hold it anymore, you're out of stock, you sell, and you're now in cash. People in cash or short sellers are potential buyers. And that's why contrarian investing works, is that it's really usually has to do with cash, potential buyers or potential sellers. You cannot be a contrarian and say, hey, the sun, it's been rising every day, in the East. I think tomorrow's going to rise in the West. You can't be that kind of contrarian. It doesn't work. That's not what we're looking for in contrarian, just taking the opposite side. And I think sometimes people misunderstand that. They're just taking the opposite side is not being contrarian. It's contrarian for a reason, right? Mm-hmm. And investing, it works because people are already overinvested or underinvested in some particular asset.
Yeah, and you raise some really interesting points here, which I think maybe get to the nature of Wall Street. And we're doing this on a day when today we have the IPO of ARM, which I think is doing quite well. It's being bid up. But this would be maybe one classic example of a stock that, because it's having its first public listing, has been front and center of Wall Street trading desks selling initiatives, right?
Sure.
And this is because they need to unload the shares, to your point.
And IPOs are a little bit of a different animal. I mean, they're usually priced, an IPO will be priced, so they're trying to make it so everybody makes money. Okay. So whoever does the IPO, they're going to underwrite at a price that is they're people that get in on the offering, make some money, but it's still low enough that retail investors can come in and they make money. So they want to create demand. Usually the person selling their private shares sells it a little too cheap. But you're right. That gets, there's an excitement there.
Exactly. So, but it has the whole marketing behind it, right? And, another example is NVIDIA. We've heard a lot about that lately. And this also gets into human behavior, which is unique to the stock market, is that as something becomes more expensive, it becomes more popular. And that's not when you're going to make money, by buying something when it's expensive. You want to buy low, sell high.
That's exactly right. And it's the old emotion of fear and greed. Mm-hmm. And you can, we talk about being contrarian investor. Contrarian investor is maybe one of 3 tools that I use. So I look at fundamental analysis. I think fundamental really is critical, because if a company's not doing well, being a contrarian isn't necessarily going to work. So fundamental analysis is a big one. Sentiment is the second one, which is you can use it in a contrarian nature. Okay. And the third is technical. And one thing that I think is sometimes technical can show the emotion. In my opinion, that is a lot what technical does. And if you think of a technical chart and you tend to have a wave pattern, and most people know what a wave pattern looks like, as you get higher in the graph, in the chart, you start getting a rounded top. Okay. And then it kind of peaks, and then it starts heading lower, and then it gets lower, and then you get a rounded bottom. Okay. And if you do the math on it, it's the slope of the curve. So most charts should, and you can look at the psychological, you talked about the psychological, process behind trading and investing and all this. And there's a big part of that, but that's what a chart should do. When you see a chart or the technicals get inverted, meaning it's accelerating up faster, and instead of smoothing out, it's accelerating up, or conversely accelerating down, that's a great tool to look at if you're looking at technical analysis that reflects the panic. Mm-hmm. It reflects the emotion, and you want to be a contrarian when you see charts are parabolically moving.
Yeah.
If that makes sense. Without trying to catch the top or the bottom, you usually want to wait for them to peak out, either bottom out or peak out. But those usually are extremes of emotion. And it's usually a contrarian move. You want to be contrarian in that. Everybody has said you have to buy NVIDIA, AI, boom, 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 and it panics up, and then it cools off. Yeah. And then they say, oh, this is not real, and it panics down because they all got to get out at the same time.
Yeah. Yeah. So we mentioned at the top, you've had a long career on Wall Street, and you mentioned gold, and then 08 and 09. Are there any other examples you have maybe in more recent memory that were kind of blaring contrarian buy or sell signals that you can tell us about?
Well, yeah, I mean, you can look at recent stocks. There was, there's a number of them, and what people, I think one of the things is, when you're a contrarian investor, you don't want to be a gambler. And what do I mean by that is you don't have to be in the market all the time. Contrarian viewpoints don't usually happen till you get an extreme. Okay. And a great example, this happened a number of years ago, but I remember CNBC, which is a great indicator of contrarian sentiment. And we always joke, the third time you hear somebody tout something is usually the end. And that's a lesson. It's a funny story that we can talk about. But, I learned that early. Apple, CNBC actually had a segment on where they had fund managers that were 100% investing in Apple. The day that they showed that segment was the top for the next year in Apple.
Yeah.
Okay. And it's just because everybody said you have to buy, and they talked up the segment, and everybody says, oh, this is all I have to own. And then it peaked, and that was the top. What I can, there's a lot of small ones, but I'll tell you two kind of extremes. Back in 2099, the NASDAQ was around 5,000, and it had gone dramatic rise. But for a year, people were saying it was overbought. It was overbought. But it wasn't until we got a 10,000 target on the NASDAQ. It's always, I don't offend any of your listeners, but it's always some young kid just out of college says, it's going to 10,000, because he's been long. And that's often the end of the road. And one of my famous forecasts was I was known for calling the bottom of the market in 2009. I missed it by 20 minutes. And I had been saying for 3 months, you should be nibbling on stocks. You should be nibbling on stocks. I don't know where the bottom is, because you never know. You never know. But the extreme was, again, this new guy on Wall Street. And I think we hit 666, and he was calling for a 50% decline in the S&P 500 after we'd made this big. And I just said, okay, that's it. That's it. And it was 20 minutes away from the bottom. And sometimes it's that contrarian, right? Where you just see the towel being thrown in. Everybody's kind of going one way. On one side, it was the up, and on this side, it was the down. And you just see that towel thrown in. And that's when the ideal time is to strike as a contrarian investor.
Okay. By the way, it's not just young investors who make those calls. There are There are some older ones, not going to name any names, Jim Cramer, but yes. But anyway, this kind of begs the question, what your view are on today's markets. And to kind of get a little bit ahead of ourselves, there's a reason I didn't lead the episode with this, but I'll let you tell it. What are your views right now on today's markets and where there might be opportunities?
I mean, I think there's, I kind of feel like we're going to be chopping around for a while. We're at the later end. So you got to look at fundamentals, right? 3 things. Fundamentals. We're at the end of the hikes. We might hike again. And I actually think Powell's going to stay. He's going to stay hawkish. So I just think he's wants to get inflation under control. And the numbers yesterday and today were not good. Mm-hmm. They were not good. And inflation is lingering. And it's not just in lingering, but we had this huge pop. It's not going back down. So I actually, but we're having great action in the market today. Okay. So I tend to be the guy that we're long-term investors. We have our fund is a top 1% fund, I think, as you know, and what we do is the same thing every day. We wait for extremes, and then we might fade that move a little bit. But right now in the market, we stay invested. I do think we're at the end of this rally. I don't see it dropping 20 or 30%, but I could definitely see it chopping around. But we don't usually make a big direct move unless I see some extreme sentiment. There is no extreme sentiment. We're trending above the moving out 200 moving day average. Long term, we look good, and so I don't feel there's any strong pull one way or the other. I think the valuations are a little on the high side, but we're also at the tail end of the Fed's hikes.
Yeah. Like I said, there's a reason I didn't lead the segment with this. But so what kind of you mentioned technical indicators and other kind of signals that you look for, these extreme emotions, I guess. fear and greed. Is there anything else you can tell us about as far as indicators of those?
Well, so on a technical basis, I look for inverted curves.
Yeah.
There's a great story that I learned early on the floor of the exchange. We wait for not one, it's not one person that tells you to do something. It's when you're at the tail end of people saying, buy this, buy this, buy this. And so when I see 3 guys on CNBC, I know it's time to say one thing. I know it's getting a little bit old.
Do you actually keep track of these in a spreadsheet or something, or maybe have an intern do it? Okay.
You kind of get a sense.
Yeah.
You kind of get a sense. So there's a funny story that when I first started on the exchange, right? People were giving inside tips all the time, because this is back in the late 80s, early 90s, and you'd have insider trading. People say, oh, you should buy some of this. Well, they never work, right? But I remember
hang on. So it wasn't insider trading. It was just rumors of insider trading.
Oh, well, yeah. It was, but people always say, hey, they would know certain things, or say, hey, somebody's buying something. You just wouldn't do it because it just didn't work. But I remember being on the call and...
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
I've learned a bunch of lessons that when everybody says to go one way, you want to go the other way. But it's not after one instance, it's after numerous. So here's a story that was the best. So Murray Sandler was my instructor on the desk at Kroll Weeden. Okay. And he was great guy, Jewish guy, friends with all the Jewish traders. And my friend George Casey said he's friends with the Jewish mafia. George Casey was my other boss. He's Roman Catholic, and he's this big guy and loud and boisterous. And Murray was the nicest, best boss I ever had. So the two of them are a little bit different. And we had a joint pool. And when we had a good trading idea, we'd put it into the pool. And so he goes, the phone would ring and they say, hey, is Murray there? And I give him the call, and Murray talked to this guy, and he yell out to the George. He say, TJI, and George would yell, okay, sell 10,000 shares of Intel, and would place the trade, and it would work. Month later, same guy call, is Murray there? TJI,
Wait, what did TJI stand for?
Well, I'm thinking, I don't know. And I'm thinking, is it Tom Jones? Is it, there was one of the guys we worked with. And after about 4 or 5 of these trades, it starts working out. So I go to the guys and I go, who is this guy, TJI? How is he so good at telling you where the stock's going to go? And George starts laughing as hard as I've ever heard. He goes, you idiot. He goes, Murray is part of the Jewish mafia. He goes, TJI is third Jew in. And I'm like, what? He goes, when Murray's third Jewish buddy tells him to buy a stock, we short it. And vice versa. If they say to short it, we buy it. And I go, what are you talking about? He goes, by the time one of us, all our friends, have told us to do something in the market, when the time the third guy's told us the same story, everybody has bought that stock, and we know that they're all sellers. And that was the first contrarian. It was the second contrarian lesson I learned. And I learned it from my great, great friend, Murray Sandler, who taught me this. And it was just a great lesson that when everybody says to go one way, you wait till they're all loaded up and they all own it. And that's when it works. And that's why you have to be patient with contrarian investing.
So what does one do when there aren't any opportunities, like you said, because cash, well, I would say cash is trash. Of course, nowadays cash will earn you, a couple % there, but even in a savings account. But so do you put it in short-term bonds? What do you do while you're waiting around?
Well, I believe, I'm a longtime believer that the market goes up over a 5-year, 10-year period. It beats bonds. It does. And, that I believe in that. That's what our fund does. We buy the largest U.S. equities. We hold them long-term, and we generate some short-term option premium on top of it. And what we do is we look for opportunities to if we see a chart where it spikes up, we'll sell some calls, and drops, we sell some puts. But we try to be patient. We try to do the same, stay invested, and look for these outliers, if you will. Another perfect example. You asked for a recent story, COVID. In March of 2020, I had a couple people that wanted to liquidate. We've had 2 people in my 5 years liquidate. So I've been doing this 30 years, but our fund's been 5.5. And both of them, it was at the bottom of COVID and at the bottom of the market in mid-March. And they said, where do you think the market's going to go? Are we going to drop? Are we going to go another 50% down, 30% down? I hear, big names, Goldman Sachs, Morgan Stanley. These people were looking for lower targets. And I said, I don't know. It feels bad. But what I know is I've been doing this for so long that when everybody's saying this, you got to invest. And I went out and I wrote a letter and said, hey, we're going to be up 30% in the next 2 years. We're probably going to be up 15% and 15%. Now, I was the only bullish name out there saying we're going to go up 30%. We went up 100%. Now, remember that. It was 100%. It's because everybody got bearish. Everybody got bearish. And what you noticed was we weren't setting new lows. And I think when you see that, when you see everybody's one side, but you're not seeing the continuous new lows, the selling starts getting a little exhausted. Does that make sense?
100%, yeah.
And by the way, you asked, I got to tell you, I feel the pain too. I felt the pain now we had a great quarter that time, and I think the market was down 20%. We were down 10, but for a long fund, that's pretty good. But you sometimes have to do the opposite of what your stomach is telling you. When it just feels horrible, that's usually the bottom. And it's not the bottom when you start feeling bad. It's the bottom when you feel like crap. And so sometimes patience is a virtue. Sometimes waiting for that extreme move is much more valuable than just trading every day.
I'm curious about another one of the recent hype jobs of this past couple of years, which is cryptos. If you have any views on that, when 2.5 years ago, when it was at 55,000, I know Charlie Munger pretty well, and I'm a believer. We just do not believe in crypto. I just don't get it. I don't get it. Buying an asset that I don't understand where the value is. I know people have made a lot of money in it, so I missed out. But when it was at 55,000, and I never made it, because people ask me all the time, what do I think? I don't know. But I remember being 55,000, they said, where do you see? And I was hearing 100, 250. I was hearing these same stories of extremes. And I went out and I told everybody, I go, it's going to go down to 20. And I think I would buy it at 11. Because I kind of looked at the chart. Now, I never got to 11, right? I didn't miss it, but it did get to 20. And I told everybody that I knew, I said, I would just liquidate. And if you really want to buy half at 20 and buy your balance at 11. Those were my price targets. So because the fundamentals I don't get. Now, I know people will disagree with me and argue and say why it's a good purchase. And that's okay. There's a lot of investments that people just miss out on. There were times when Google and Amazon and Tesla weren't making any money. And
they turned out to be phenomenal buys, right? So will Bitcoin make money? I don't think it will make money. Will it go up in value? It may. So, but the reason I got bearish 2 years ago and went out on my investor calls was everybody was looking for higher prices.
Mm-hmm.
And it was just the sign to me that when I hear that, to go the other way.
Mm-hmm. Yeah. Very good stuff. All right, Phil Pecsok of Anacapa Advisors. I want to take a short break and give our sponsors a chance to be heard, and then come back and ask you some more questions about your background, about your firm, about what you're doing out there in LA, and some other stuff. But let's first take a quick break. If you are a premium subscriber, don't touch the dial. You won't get the break. We'll be right back. In fact, we already are. And everybody else, to become a premium subscriber, visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack that where you can sign up for the same prices, same benefits, same details, contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a Contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. Welcome back, everybody. Here with Phil Pecsok of Anacapa Advisors. Phil, this is the segment of the show where we ask our guests to tell us a little bit more about themselves, how they came to investing in the first place, kind of their origin story, to put things in Marvel terms. In your case, you told us one story from your early career about how you became a contrarian, and I think you have some others there that you can tell us about.
Well, I got interested in the market when I was 7 years old. My grandfather was very, very smart and did all fundamental analysis, and said buy sheep, sell deer was his joke. Buy sheep, sell deer, but I got interested in making money. I think a lot of people, when they're younger, want to make some money, and it's like, oh, I can make money doing this and investing. Like a lot of your viewers, I think I probably lost money in the first. I'll tell you my first investment. Again, I'm 56, and it was in the mid late 80s, and I said cell phones are going to be the thing, okay, and I was right. And I said, they're going to be, everybody's going to have them. My friends laughed me out of the room. And I said, no, everybody's going to have a cell phone, right? They go, who's going to buy them? I go, old people. You need to call 911 or whatever. And so I invested in a company that sold to all the old people. And obviously that didn't do so well because all the young people bought them. If I had just bought Apple, it would have been just an amazing story, but I lost my money. And I think a lot of our lessons are the hard knocks, right? You don't always remember the ones you kind of remember the ones that made you money, but you never forget the ones that lost you. And I think your first trading, when I first worked on the floor of the stock exchange, and I loved it. I called the floor every day for 6 months to get a job down there, because that's what I wanted to do. The excitement of the bidding and asking, and I became a floor specialist and a market maker. But you always make mistakes, and it was almost always, everybody said, you got to buy this and it's going up, and it's the fear of missing out, right? The FOMO. So you don't, that's almost always the kiss of death. But I'll tell you, probably the best lesson I learned was from my roommate, Larry Yells, who went to UC Santa Barbara, and he's the only person I know whose dad did not want him to go to college. His dad wanted him to go into the Army. Okay. Most parents are proud. My kid's going to college. He's like, no, you should go to the Army. So his dad didn't pay for it. So what did he do? Well, this is back in the days where we had cable TV, and we'd go to the top of our apartment and we would splice one cable channel into 4 rooms. And we had 8 rooms. So you had 1/8 the strength signal sent to your apartment. And then we were in Santa Barbara. So half the channels were Los Angeles, half were Northern California. So we got 2 football channels for NorCal and 2 for SoCal. And we had 4 TVs, and we had old TVs set up, and he was the bookie. So he was the bookie at UC Santa Barbara, and he made all his money taking bets. So, Saturday morning, he'd wake up after a night of debauchery, and he had his yellow sheet of paper, and he'd take bets. So we would watch all the games, and I wasn't a big bettor, but we were, watching football and this, that, and the other. Well, there was one game, and not the exact details, but I think it was Jamel Holloway, and Jamel Holloway, I was an option quarterback. He was an option quarterback for Oklahoma, but he was a Heisman Trophy winner. And it was Oklahoma at Nebraska, and 1 versus 2 in the country. And Jamel Holloway gets hurt. And the line is 3, Nebraska gets 3, and they're equal teams, and it's at Nebraska. Nebraska's the home crowd. They're going to be wearing red. The Heisman Trophy quarterback's injured, and the line's stuck at 3. And I'm like, Larry, we got to bet the farm on Nebraska. He goes, I love it. Let's go. And and this was like Monday, Tuesday, and we're going to go out to Vegas on Thursday, and we're going to spend all our life savings on Nebraska. And so, Tuesday comes, Wednesday comes, and he's getting bets on Nebraska. All the guys around Santa Barbara betting on Nebraska. And we're like, oh, this is great. And so we get to like Thursday, and we're going to go on Friday, and the line's still 3. And I'm like, this is the easiest money. I'm going to take money out and invest it in Nebraska. And he goes, so this was the lesson is, he goes, Phil, I love Nebraska. You love Nebraska. Every person I know loves Nebraska. Just like a stock, everybody loves NVIDIA, right? But you got to understand this on a stock. For every stock trade, there is a buyer and a seller. And people forget that. They say, who's buying it? Well, there's always a seller as well. But it's not until the price moves that you have an excess of buyers or an excess of sellers, right? So the price, if you have an equal amount of buyers and sellers, that price stays the same. But when you have more buyers, the price moves. Fair enough? Okay. The line, Vegas wants half the money on Oklahoma and half the money on Nebraska. The line wasn't moving. Mm-hmm. And he goes, Phil, all of us are betting Nebraska. The line's not moving. He goes, I've been doing this long enough to tell you, when everybody goes one way, he goes, it almost always goes the other way. I go, how is that possible? He goes, because Vegas wants half the money. He goes, there are some very big players that are balancing out all us small college know-it-alls. And I still, I couldn't grasp what he was saying, but he's like, just trust me. Don't bet it. Right. If anything, bet Oklahoma. Well, sure enough, Oklahoma had a dominant defense. Their backup quarterback was just as good, and Oklahoma wins the game pretty easily. And it was a great lesson. That was the first lesson that I learned, that and this is what your listeners should take away, is that when you're hearing the contrarian view, if the price is still moving up, well, the buying is still there. But when that price stops moving up, as it stopped moving down during COVID, the lows started getting higher. So the selling was abating. And when the price doesn't get adjusted or the betting line doesn't move, that tells you that there's more money on the other side. And it's usually the smart money.
Mm-hmm. Very interesting. Well, yeah, that's fascinating. Although another lesson I would throw out there is that you're not going to win money gambling on sports.
That's true. Unless you're the bookie, right?
I was going to say, it's actually remarkable how efficient these bookies are. If you look at this, and I've looked into it a little bit, I mean, and that, by the way, that may be the only chance you actually have, is to somehow figure out how to bet on the fact that bookies are efficient.
Okay, so I'll tell you, there's some tricks, and we have made some money, and I'll tell you what it is.
Okay.
Think fundamentals, right?
Yeah.
Fundamentals, and then use your contrarian. The fundamental of betting is Vegas wants half the money on each team. Okay, and we're not talking about roulette or anything. We're talking about sports betting. Okay. Don't think that because you know that the middle linebacker is injured or somebody tears their Achilles, that everybody else in the country.
That's not a joke on Jets fans, but go on. Yeah,
I don't want to offend the New York viewers here. But
it's only half in New York. There are some mostly Giants. Anyway, go on. Yeah, sorry.
Everybody knows it. So the news isn't, it's known news.
Mm-hmm.
So how do you get half the money on each team? Well, we know that on the West Coast, guys at USC bet on USC. A little less, UCLA will bet UCLA. Notre Dame has a big following. Alabama has a big following. And we know that those teams are going to get an inordinate amount of money wagered on their teams. So the line has to basically be a little anti-USC, so the smart big money can come bet on Toledo State or whoever they're playing. Because Vegas wants half the money. So if all the college students are driving out from USC and they're going to go stay in Vegas and bet on their team, Vegas needs to move the line so it's kind of a little bit anti-USC. So people say, hey, I want the underdog. I'm getting a lot of points. So where do you make money? You bet against what everybody's seeing. Monday Night Football, there was a good rule. Bet against Monday Night Football, the previous Monday night winner. Why? Because everybody watched Monday Night Football. Now people watch the other games as well. But back then, Monday Night Football had by far the biggest viewing. So if the Jets win big time on Monday Night Football, everybody's going to bet the Jets big on the next week.
Unless they lose their quarterback, they just spend billions of dollars.
Well, yeah, exactly. I'm kind of joking with it here. But the point is that people see this big win, right? And they're then going to say, hey, they looked really good. But everybody saw that. And so the next week, that line is going to be anti the Jets. Whoever they're playing or whoever played Monday Night Football is going to get a few extra points. The other thing is on Monday Night Football, you have a shorter rest period, right? You have an extra one fewer days of practice. So there was another reason why you wouldn't want to bet on that team. The other one is previous playoff teams or previous Super Bowl winners. You almost always bet against them because everybody thinks, oh, these guys are really good, right? They won the Super Bowl, or they just barely lost in the Super Bowl. They're good. Well, everybody knows that. And so again, this goes to your contrarian. Why does contrarian investing work? When everybody is kind of a similar mindset and they're all putting their money onto it, you need Vegas wants half the money on the other side. Okay. So take this analogy to the stock market. If stocks are going up you kind of got to go with it because it means there's more buyers than sellers. And right now, that's kind of what we have. It's when everybody says you need to be invested in the market, and then we start getting lower highs. That's where the ideal timing is to be the contrarian, because everybody's fully invested. The big money's starting to get overdone, and they're starting to short or sell their positions. And that's really where you see the tide change.
Mm-hmm. Yeah, that's some fascinating stuff right there. Yeah. I got another one, by the way. Maybe this isn't the time, but on the sports betting, efficient bookies, I may take this out, but just okay, so bookies are efficient, so that means that the against the spread lines should hover around 500 for most teams. So as the season goes on, if you take teams that are really out of the far away from the 500 level and they're against the spread record, take the other side. And so, or if they're below, yes. And that kind of, it works in my pool, but.
Well, okay. So you brought up a great point. Okay. The other thing that you see is when you see a pattern go against the pattern. And that's throughout the industry. For example, we look at the top quartile investors. Now, here's a really interesting one. If you look at the S&P 500, and I think there's 2,000 funds that are large cap S&P type. And so to be in the top quartile, you have to be in the top 500. Okay. Or if we just want to say, let's look at all mutual funds. Who's in the top quartile for 2022? And you said, hey, those are the best managers. Okay. If I just invest in those, how many of those will remain in the top quartile the next year? Right. And it's going to be above 25% because we already know they're the best managers. Right. And so if you took the top quartile and you say, who's going to be in that the next year, it's going to be it's going to be somewhere above 25% because they're the best managers. Well, the number is under 25%. You go, well, wait, how is that possible? And the reason is whatever worked one year doesn't work the next year. People look at it and they go, hey, this fund's doing real well. They take extra capital and everybody kind of goes, hey, this strategy of buying Tesla or this strategy of buying IPOs or this strategy, whatever it is that worked last year was shorting, doesn't work this year.
Yeah.
And I mean, we got lucky where it went short and then long, but that tends to happen all the time, right? When everybody says, and it's because too much money is going one way and it's overcrowding a trade. It doesn't work. It doesn't work. It gets too full, and that trade gets too full, and the strategy doesn't work as well as others.
Last question while I still have you here. I like to ask this of people, going back to the fundamentals. What's something that keeps you up at night? What's something that you're particularly worried about, other than the obvious, like nuclear war and things like that, which we don't need to talk about, but other maybe disaster scenarios? Could it be Fed rate hikes? Yeah.
I don't see anything. There's always war, right? There's always Russia does something crazy or China goes after Taiwan. Those are probably the major, quick terrorist attack, quick short-term threats. Okay. In terms of the stock market, is it a little pricey? It's a little pricey. It is a little pricey. I think when COVID happened, people were able to raise some excess cash, staying at home, not traveling as much, not eating out as much, whatever. And that cash has started, I think it's evaporated if you look at it. And so, we're still seeing rates. I mean, rates go up today and the market goes up, and that's not how it should be. So I feel like we're getting a little bit we're getting a little bit exhaustive here on the upside, but I don't see a big downdraft. Could we get a 5 or 10% correction? Sure. But I don't see a disaster. in the making. Could you get 3 years of a slow drip? Possibly, in the mid 70s, right? When we had inflation, we had what was called a bear market. And bear markets are not straight down. People forget this. Bears hibernate. And that's what it was in 73, 74, maybe 75. I can't remember, but it was when hibernation. And people are just like, interest rates were too high. People could get 10, 15% yields, right? And that, why would you buy stocks? And so you could see that, but that's not happening now. It's just not happening. There's too much. The zero DTE, you haven't talked about that, but with zero dated options, 0 days to expiration. And I still always wonder, why is it zero DTE? It's 0 days till expiration, 0 days until expiration, but that's another issue. I just always laughed at that, but that's what it is, right? And so you have a lot of gamblers in the market. You got a lot of gamblers at COVID. Hey, I'm not working. I'm gonna day trade at home. Well, guys like me love that. That's great because I get to go against the amateurs. And right now, COVID, we had a great couple of years, and then now these guys are coming in. We call them yahoos, right? They're, hey, I get to trade options today, and I'm like, you're not a professional.
Yeah.
I almost feel bad, but that's our fund actually takes advantage of that. So we counter the small trader, which is a contrarian point, right? I don't look at the big, I look at the small. What's the small guy doing? They tend to be wrong.
How do you find data on the small guys, or is it just like a sense?
Theta?
Data. No, not the data. Like, how do you find information?
Data.
Yeah.
There's a few services that I subscribe to.
Okay.
And if you want to know something, it's a good question, because you never really know if it's a buyer or seller, right? This is, somebody bought a boatload of options. Well, somebody sold a boatload of options. Well, somebody initiated the trade. Yeah, but somebody is also on the other side. So you don't really, it's a fair question. There are, if you house the data yourself, like a Fidelity or a Citadel or somebody that trades, they see these smaller trades and they can piece it together. And then if you can kind of get that information, but a lot of that is valuable and it's usually proprietary.
Yeah.
So that's a great question, but it's hard to know what the small investor is doing. It used to be odd lots.
All right.
That used to be the indicator.
Right.
But I look at put call ratios a lot. Put call ratios aren't as I love sentiment indicators, right? Your contrarian, it's a great way to look, especially short term. Because think about this is one last take for your viewers, is why does it work? Well, let's look at Nvidia or Apple or any bigger company, and there's news out, right? Why would the stock move so much over 2 or 3 days? These are big companies like oil tankers. They don't turn on a dime. And sometimes you can trade against the short-term news. A perfect example is earnings. Nvidia comes out, great earnings, stock's up. Comes out, great earnings, stock's up. Last one, great earnings, came up, stock, and then it dropped. And people go, why did it go down with such great earnings? And maybe you've covered this before, but it's because everybody's loaded. Everybody knew it was going to go up on the earnings because they've seen the pattern. We talked about this earlier. When you see a pattern repeat, it's not, because everybody's like, oh my gosh, I'm going to make all this money because Nvidia is going to come out with great earnings because they have the last 2 or 3 times. I'm going to get long and I'm going to make all this money. Well, you might, but then everybody else is doing the same thing. They're all going to sell it. That's contrarian investing. That's contrarian investing. You've seen the pattern happen 3 times. The first time Nvidia popped with AI news, that was a novelty, right? The second time was, oh, this is real. And the third time it gets old and it reverses. So that's something that your viewers and listeners should take note of. Is when you start seeing a pattern, it probably will not repeat, because other people, if you see the pattern, don't think other people aren't seeing the pattern.
Of course. Yeah. Very interesting, Phil Pecsok. Thank you so much for joining the Contrarian Investor podcast today. Maybe in closing, tell our listeners how they can find out more about you, more about the firm. I checked, you're not on social media, at least from what I could tell. Not on Twitter, at least.
No, I'm too old.
That doesn't really disqualify her, but be surprised. But yeah, and I'll put this in the show notes too. How did people find out more about you and the firm?
We have a great, it's anacapaadvisors.com. Anacapa is off the coast of California, anacapaadvisors.com. We're a very conservative hedge fund, and we're a hedge fund because we believe in charging. We have the lowest fee out there. We're half of 1%, and if we beat the S&P, we get a bonus. So that's, my mom's in it. My friend, it's what you want for yourself. You say, hey, if my manager does really well, he gets a bonus, but I'm not going to pay you a lot. And this is built over, out of love. I use all the things I've learned over the 30 years. We use contrarian investing. We use fundamentals, and I appreciate the plug, but they can probably access us through anacapaadvisors.com. There's an info page, and I'm not a big marketer of it. And if people are interested, they can reach out and I'll send them some info.
Fair enough. All right, I'll put that in the show notes as well, so people have the link. And that's it for today. Thanks to Phil again for coming on. Thank you all for listening, and we'll speak to you again next week. See you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.